Hello, I'm John Fagan, and welcome to the Markets Policy Macrocast. I'm joined as always by Brendan Walsh, and we are in the short week after Memorial Day. It's been a relatively placid week in financial markets, but some interesting stuff has gone on. Particularly today's data was uh, was anticipated. There was some heartburn potentially coming into today's U.S. inflation reading, which is the core PCE price index. It's a little bit of a mouthful, and
Yeah.
it's the Fed's favored. I guess it's still the Fed's favored. The core PCE price index is the Fed's favored inflation gauge. Um, to the extent that they focus on one in particular. How did it come in, Brendan?
Yeah. So it came in very much in line, though. So this number is based on a large amount of data that we get from the CPI and the PPI and a couple other inputs that people know. So you are able to kind of recreate it if you know the weightings and things like that. But the estimates were coming in right around 0.25. So that was kind of the drama. Was it going to round up to 3 or was it going to round down to 2? It's kind of silly, but it did. It rounded down to zero point 0.2 on the monthly basis. Um, Even if it rounded up or down to 2, it wasn't really going to affect the year-over-year rate, which came in at 2.7. And then the headline, which includes food and gas, is 2.8. So the two of them are kind of going back to a little bit normality and running on the same kind of trends. Uh, we also, in terms of headline inflation, gas prices or oil prices have been coming down, so that should feed into gas. But also, there's been a lot of announcements, of big box realtors, especially the grocery stores, lowering costs because the consumer is kind of feeling the pain. So they're lowering costs, which their input costs aren't being lowered, so that's going to come out of their margins. And that actually was probably the more interesting data point we got today, because with the inflation, we also get personal income and spending. And income was up 0.3% on a monthly basis, but spending was only up 0.2, and that's down from 0.7 last month. So it's not necessarily that the consumer's tapped out, but it's definitely slowing, and that's what higher rates do, and that's what kind of the message we keep getting from the Fed is, higher rates are working. We need to stay the course, but probably in the back part of the year, it might justify, as long as inflation prices keep coming down, us to start slowly cutting as the year ends and into the new year.
Yeah, as we've said before, pricing power is not infinite. We've heard some of that coming out in earnings, this past quarter's earnings. Some of the retailers and the
Yeah,
like
especially this
P&G
week. Yeah,
staples. Yeah,
there's some big misses. Yeah.
yeah, absolutely. I mean, Target had a big miss earlier, and we've had some pretty lackluster responses from some of the big retailers.
Yeah,
And
Salesforce was a big disappointment yesterday.
yeah, and yeah, it doesn't appear like, we're falling off the cliff or anything
No.
like that. And certainly if you look back at the middle of the week, we got the purchasing managers indexes, the preliminary ones coming in for the month of May, and
Okay.
those looked very strong. Uh
And not just the United States, but globally, they kind of surprised to the upside. And the US was actually a pretty big surprise to the upside
yeah, we'll talk a little bit
for
about
the
China.
manufacturing. Yeah.
Yeah, China was a bit of an outlier, not a huge disaster, but we'll get into that in a little bit. But back to the U.S. Yeah, it seems like we had that kind of data, the upside surprises in PMI early in the week, and then the sort of, I guess, modest downside surprise in core PCE, and particularly the spending here has created this kind of two-step in
Yeah.
this in treasury markets this week. A little bit of run up in treasury yields, and then settling back down a little bit today. When you look at the Fed's Fed fund futures, it's essentially still September is the base case for the start to Fed rate cuts for this cycle, but it's nothing better than a coin flip at this point in the implied odds. And I think that July is sort of where we've had a long. I think we've been in Yeah, our first rate cut in July has been our call for the last 6 or 7 months. So why ditch it now? We're out of consensus.
Yeah,
Still in July, but acknowledge that it's,
but there's a
the
lot.
risk is for later.
Yeah, but it's not that we just, chose a random date and we're sticking to it. It actually does make sense, especially, which we'll get into in a second. DC was kind of quiet this week, but Manhattan was busy. And we are in election season. And if the Fed will have two more data points for inflation and jobs before they make their decision because it's at the end of July.
Yeah, it's like July 31st.
Right. And the election day is in November. You as the Fed do not want to be part of the election, discussion noise. So if you're confident you're going to do it in September, it really makes sense to actually do it in July and just get it over with.
Yeah, that's right. And then you have the ability as the Fed to message that this is, this isn't the start of an automatic rate cut at every meeting. This is we're taking it meeting by meeting. We're taking it slow. We're going to pause potentially. And I think that that's kind of the careful, cautious approach that, it still
Right,
makes a lot
which
of
is
sense.
why I think they kind of took the market off guard at the end of 2023 with the pivot, because they wanted to get the process started and be able to start cutting before the election. You don't want to do it first time in November, especially if it's actually needed.
Right, right. Yeah, the implied odds, just looking at those now for a cut at the July 31st decision, down to 12.3%, according to the CME website there. That, they may not cut
I think
in
we got down to
July, but that's
10%, so it's up a little bit.
yeah, it's up a little bit. That's yeah, as we said in the last one, they may not cut in July, but 12% is too low. They've got much higher odds, particularly as you said, with the additional data points coming in,
There's
and
just a lot of
likely
data
cooling.
coming. Yeah, and the world could look, especially the inflation data, could look very, very different, especially if the housing numbers start to really fall. That's going to massively drag down the monthly rate and especially the yearly rate.
Yeah. Speaking of rate cuts, the European Central Bank looks like they're going to be the first major central bank to get into the rate cutting business here at the meeting next week in June. Now, it's not a foregone conclusion by any stretch of the imagination, but there have been a lot of signaling and not so subtle signaling that getting started at the June meeting is what they're thinking in
Yeah,
the
so I wanted to
ECB.
ask you about this because in your previous career, you were much more of an FX guy than I was. Usually the other big central banks follow the United States. This time they're going to be leading us. But with that, everything's not static. You can lower rates, but then the FX can change. Do you think that first cut will have the normal monetary effect on the economy, or is the FX reaction to it maybe going to overwhelm it?
Yeah, I mean, I think the euro FX markets have been pretty, well, I want to take FX markets have been pretty interesting in Asia, but
Yeah,
Europe, the
Japan's having a
the
good time.
euro, yeah, the euro has been very, very steady. I mean, essentially, it's been arranging sideways against the dollar, and the idea of the ECB getting started in June, that is balanced to some extent by the fact that their growth data has been getting pretty firmly upside surprising has been the trend,
Yeah.
and I think that kind of the idea that you've got less of a stagflationary problem in Europe. You've got the economy coming out of what essentially was kind of a technical recession, and looking a little bit better. That has kept the expectations management by the ECB has kept volatility low. They've signaled everything pretty clearly, and the data has been very much in line with their narrative. We haven't gotten a lot of big shocks. Now we got a slightly higher reading from May's consumer price index this morning out of the EU, but nothing particularly eye-popping. It was just, a tenth of a percent higher than expected. And on month basis, it was really tame, 0.2,
Right,
down
exactly.
from
Right.
0.6 in April. So it's more like a year-on-year
It
comparison
was a
thing.
year thing, yeah.
Right. And the core was basically, the same kind of story. Nothing, nothing too eye-popping, just slightly a tick higher than expectations. And, the European Central Bank has said, very much their policy, they've characterized their policy very much like what we expect the Fed to do when they start cutting, which is, we're going to start now. We think things are going in the right direction, but, it's not that this isn't, mission accomplished. This is just us, beginning to, you know, rates are still restrictive, even if we cut 25 basis
Yeah,
points.
exactly. Yeah, yeah.
And we don't have to cut every meeting. We're going to take it slow. We're going to watch and make sure. And you referenced it before. One of the things that would be consequential is if you saw something like oil prices shooting higher, and that is, even with OPEC kind of on the meeting again this weekend and likely to extend their production cuts.
Well, it's
That
been very
is,
interesting. Yeah, oil's had the worst week of the year in the face of a meeting on Saturday that all the leaks have been coming that we're not we're trying to raise the price of oil.
yeah, it seems like oil has been like comfortably range bound, and it really, not a big story. And I think that that's for the perspective of the macro economy. That's kind of where you'd want it to be. Would it be better if oil prices were a little bit lower? Yeah, but they're kind of Goldilocks right now. I
Yeah,
mean, like
and there's just
W,
there's a huge amount of supply.
right. Yeah, and we keep seeing that in the
Both
inventory
domestically
numbers.
and abroad.
Right. And that's a good segue into, one of the big drivers of upside for oil prices and commodity prices in general is expectations about China's growth. Now,
Yeah,
Beijing has been back on the stimulus train. We had the fantastic Logan Wright on the Macrocast a couple of weeks back. He's the director of China market research at Rhodium Group. And his view is that, in the near term, you do have some traction from from Beijing's supportive policies trying to get the housing market out of free fall. And Logan, I think, is quite optimistic that that market has adjusted pretty significantly, and maybe the hard part is over. That doesn't mean it's going to be a big engine of growth. So Beijing is trying to pivot toward manufacturing. And it seems to almost be, just the implication is that they're waving a white flag on the Chinese consumer. The idea of
yeah,
consumption-led growth was always the idea of what a real reform from China would necessitate. But it just hasn't materialized. It hasn't been able to, the Chinese shoppers just haven't been able to drive that economy. And so Beijing is going back to an industrial policy. Overcapacity in China is already an issue, one might think, in a couple of different industries. And so the idea of Beijing really pushing an expansion of their manufacturing at a time when Western companies are thinking a lot more and acting a lot more on the reshoring aspect, trying to de-risk a little bit their relationship, because who knows these days, tail risks are pretty chunky, and everybody can read the news about Chinese People's Liberation Army exercises around
exercise.
Taiwan, which give you a shiver up the spine.
Yeah,
Uh,
and
and
this
so,
time they actually said, we're the trials, the test that we're doing is to see how we would invade this island. They said it
yeah,
out loud.
it's not good news. And so certainly, in Western companies invested in China are clearly, monitoring and trying to, increasingly risk manage that. So, China's overcapacity, are they really going to be able to juice the economy with this big manufacturing drive? Well, it's not an immediate thing. The Chinese leadership works in sort of a pretty long time horizon. But we just got some pretty dispiriting figures on the Purchasing Managers Index. Their May index for manufacturing slipped back into contraction for the first
Yeah,
time since February. That's not what you want to see if you're Beijing. Now, 1 month can be an outlier, of course, but that if you're trying to trying to pull the economy out of its malaise with a manufacturing-led push and your manufacturing gauge, the official China manufacturing gauge ticks back into contraction
Yeah.
during
And
that
especially if
push.
you're
Not,
China,
not great.
the government, you can push manufacturing, but someone has to buy this stuff. These are all exports. And what we've been seeing is because of everything that's been going on in China, the big multinationals are trying to pull as much of their manufacturing and supply chain out of China as possible. So it's a double-edged sword.
Yeah, and so unsurprisingly, on this, all of this has created, as we alluded to before, a real structural weakness for the renminbi, and
Yeah,
so the renminbi is at its weakest level in, boy, I mean, you got to go back, right? It's like, what is it? It's 07. It's the
probably.
weakest
Yeah.
level since 07, and certainly doesn't appear to be
Yeah. It's
heading
also
in.
important to know like the renminbi is not a free floating currency. It's manipulated by the central bank and the government. So that's even more troubling.
Yeah, it's stage managed by the government, and there are indications you can get a sense of which way the government by looking at their daily, what they call the daily fix. They have the renminbi basically fluctuate on a daily basis in a basket, and then on the day on the when it opens, they set the new opening mark for the renminbi, and you can kind of see where Beijing's policymakers are leaning, and they seem to be essentially leaning into depreciation of the renminbi.
Yeah.
They don't seem to be pushing very hard against it, and maybe even pushing it in that direction a little bit. So, that's a help to their industrial policy because of the export oriented. Weak currency gooses your exports, but it's not going to make it very much more popular with its Western trading partners that are concerned about you know Chinese essentially dumping and over capacity and flooding the markets with EVs and other things. So it's a political issue, and Beijing's strategy here is definitely gas on the flames. So yeah, the taking a step back and looking at the state of play here. In general, we expect the European Central Bank to get going next week on rate cuts with a cautious kind of hawkish message. We think the Fed actually gets going in July, counter to in defiance of financial market expectations right now, but again with a similarly kind of cautious posture going forward. We think that the inflation picture in the U.S. is easing and that the coming months will feature, lower and tamer readings across the CPI, PPI, and the Fed's preferred core PCE price index, which we got this morning. And we think that the U.S. economy is, softening but not falling apart by any stretch of the imagination. This should, all else being equal, be pretty soothing, a kind of soothing outlook for Treasury markets, right?
Yeah, I agree. Yeah.
But all else is not equal, as so often is the case, and there is a pretty significant there's a pretty significant event happening in November that is definitely creates and will increasingly create uncertainty in financial markets. And we had the big news last night of the 34 felony convictions for former President Trump in New York. We'll leave it to the pundits to decide how that's going to impact the race and so forth. We've all seen the polling and so forth, but we'll see how that plays out in the
Yeah.
coming months. Our base case remains that this is a really tight election,
Yeah.
and that going into the summer, it's usually not until July and August when the election really gets onto the investable horizon for market participants. That's, before that, it's just too far out. The polls are too all over the place. People aren't really paying attention to it. But by late summer, and when the conventions kick in, that's when we think that the markets will begin to price in some of the potential policies. The expectation that we have is that a Biden in second term would come with a divided Congress and essentially have far less market moving consequences
Yeah, more of the
than a
same.
yeah, more of the same, and divided Congress, so they can't really get that much done, and nothing particularly earth shattering. A second Trump term would be tend to, likely come with both houses of Congress going to the Republicans, which creates a much more obviously active legislative environment. And we think that, even if former President Trump isn't, going to put in place all of the economic policies that he's espousing on the campaign trail on day one, far from it. But even if he doesn't get all of them in, it's still a relatively inflationary and stimulative policy mix that he's advocating. Major
Bill
tax
Gross,
cuts.
who was a lifelong, large investor in the Treasury market, and so his opinion matters on Wall Street. He said he thinks that a Trump presidency would be very, very bad for the Treasury market.
Yeah, and it's hard to disagree, really. I mean, we all saw how the Trump tax cuts, impacted the budget, and so the idea that tax cuts pay for themselves, I think,
The
that's
budget's
not a serious claim.
gotten a lot worse since the tax.
Yeah, and obviously the COVID spending and so forth, and the legislative the legislative accomplishments of the Biden administration are impressive, but still represent major fiscal outlays.
Yeah.
And so it is in that backdrop, when you have the also inflation, whether it's even if it's lower, it's still going to be sitting there in the background as an issue, and so if you throw into that mix the kind of 2016 policy mix that President Trump brought to bear, which is essentially pushing the Fed to lower interest rates, whether that works or not. It's still jawboning, and he may get more active this time in trying to convince the Fed for lower interest rates. Corporate tax cuts. I mean, the modern Republican Party does one thing particularly well, and that's cut corporate taxes, cut taxes in general. So one would assume that he would go back to the well on that front. But obviously, some of the other policies.
Yeah, and one way or the other, you're going to have to make a decision about, especially the individual rate, because it was done in reconciliation, so it's running off. So we're going to have to adjust through Congress one way or the other.
Right, absolutely. And then into that, you get some of the other policies like the immigration policy, whether you're for it or against it, that's inflationary, right? If you're taking a pool of workers out of the United States or limiting
and actually that's been a lot of the reason that the economists have been wrong, and they've admitted it, that the economy has been stronger than they would have thought, is because the labor force has grown more than anyone would have predicted, and that's basically due to immigration.
Right. And last but not least, is sort of the tariff approach. If he's taken at face value, which, you have to take with multiple grains of salt.
Those are some big numbers.
Yeah, tariffs are inflationary. We've seen that before. And, the obvious risk that China pushes back a little bit harder than they did in the 2019 trade fight. Yep. These are issues that could really impact the Treasury market. We think that the Treasury, the volatility index, the MOVE index for Treasuries is on the way up, and we think it's going to hit keep going higher to a significantly higher plane as market participants begin to focus on the potential economic and policy ramifications of some of the election outcomes. So let's see. Next week we've got, as we mentioned, the European Central Bank. We have the Bank of Canada, which looks like they're going to hold things steady.
Yeah.
And on the data front, it's non-farm payrolls. It's a big payroll number. So we'll see. The last reading was lower than expected, but still, what was it, 175? I mean, that's not a bad number by any stretch of the imagination.
No, anything anything in the hundreds is kind of that Goldilocks number that the market very well.
Yeah, the market will like that. So hopefully we get something that's steady as she goes, and we're getting more global purchasing managers indexes, retail sales, and some other data next week. So tune in for that. We'll be back on the Macrocast next week. Thanks for tuning in. John Fagan, Brendan Walsh. You can find us online at marketspolicy.com. Thanks for listening.